Well, I guess Michael Burry's kind of rubbing off on everyone. I mean, we got more and more folks coming out saying this is basically just a bear market rally. Just wait, everything's going back down, making new lows, blah, 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 blah. Now, to be clear, I'm not saying that isn't true at all. I'm not saying it can't happen. I'm not saying this isn't a bear market rally instead of the start of the next bull run at all. What I'm trying to tell you is when you kind of start digging into the details of what they're saying, and we'll watch right here, we'll break it down, you kind of see to where their messaging, although last year was very much spot on and made a lot of sense, a lot of the things are starting to kind of decouple now and recover, and their cases are kind of falling apart within their actual argument themselves. So I'll make sure we point those out to you guys specifically today here. Just make sure you like the video and subscribe if you like the truth without the hype, and if you like me calling out these Wall Street folks and kind of giving you guys the inside scoop on what they're doing there. And also don't forget the Valentine's Day sale is live to join the group. You don't want to miss out on that, guys. Check out the pinned comment down there. It's got more stuff than any other group out there for the price, so check it out and see what you get. All right, so let's see what this guy has to say.
Have things changed this year? Do you think that there's a different risk-reward setup? How are you playing it?
Yeah, I don't think things have changed too much. I mean, obviously the stocks are down from where they peaked, but you have to remember last year it was really about inflation and the Fed. And so for the first 6 months, the market went down despite earnings forecasts going up. Then you sort of got to mid-year and earnings forecasts then finally started to come down. And I think what you're going to deal with in 2023 is the aftermath of all of those rate hikes you saw in 2022 starting to play through to earnings. And you've already kind of seen it with some of the bigger tech companies like Microsoft that have reported and guided. Now, obviously, the stocks have gone up, and you can call it the January effect or, whatever you want. But it's typical that the market tends to drive up the stocks that were oversold in the prior year in January, at least to start the year. And, that's what you've seen, right?
So basically said right there, hey, they were oversold last year, so the market tends to rally them, at the beginning of this year. I agree there, but I don't know. He's kind of saying it's going to be, and you'll see it as it goes on here, kind of leans more into the narrative of, hey, it's going to get worse. Hey, we're, just now seeing the effects of the rate hikes next year, which I agree. We're going to start seeing those more and more in the economy as this year goes on. But if you've already adjusted your guidance for that, remember, Wall Street is forward looking 6 to 9 months. And 6 to 9 months from now, if everybody that, lowered their estimates hits those estimates, those are earnings gains and coming off of a year where you're beaten down so bad. And we're already seeing that with a lot of stocks, right? How many misses just happened? I mean, Meta missed, Amazon missed, Apple missed. I mean, a lot of these companies missed and they ran up. I guess Amazon didn't, but definitely Meta and Apple, both of them ran after earnings based upon misses. Now, obviously, Apple didn't get the beat down that Meta did. But Meta went down, crazy, crazy low. And then now it's recovered back up. And even though it didn't have a great, quote unquote, double beat, incredible earnings, it still shot up massively after the earnings. So that narrative is kind of starting to unwind here a little bit. So I'm paying attention to results in the earnings and the aftermath of those earnings, not necessarily a narrative of, well, the market tends to do this and the market tends to do that. And these very broad generalities that are great if we're talking about an index fund. But I don't invest in index funds, and I know a lot of you guys don't either. I buy individual stocks, so a lot of this doesn't make sense with that, or a lot of it just is irrelevant to that because I own the individual stock that doesn't always move with the actual market itself.
Education services, information technology, consumer discretionary, those are the three best sectors this year, up 8 to 13%. And the best sectors from last year, healthcare, utilities, staples, they're all down for the year. So.
And the reason why that is valuation. Those companies, those consumer staples, safe stocks, whatever the heck you want to call them, defensive stocks, those are way overvalued now by any metric. Any metric you want to look at, go back, forward PE, PE, do a DCF model, any of them, they're all significantly undervalued, whereas opposed to big tech, in the case of like what we'll use, for example, here, obviously Meta, lowest, it was in the 9s, 8, 9, 7, 8, 9, something like that in the PEs. Google trading at its lowest valuation ever, November, December of last year. So you have big tech and a lot of tech names and a lot of small cap names that were trading the cheapest that they ever have in a lot of cases, or cheaper than they have in the past 5 or 10 years in other cases. And then you have these other stocks trading at, in terms of valuation, some of the richest they've ever had since they were a growth company 50 years ago or whatever the case was. So of course you're going to see that swing. That valuation always matters in the end, and it makes no sense for defensive type stocks to have higher PE ratios than growth stocks and mega tech stocks and all the other companies that typically carry and demand much higher PEs in a normal market. So that to me just makes perfect sense. And I don't know why this seems to be confusing or why this is hard to believe that, I understand it's not fitting necessarily the narrative that's out there and such, but you'll kind of see as it goes on here, it kind of falls apart on this guy a little bit.
I don't view this anything more than another bear market rally like we saw last year. We saw 7 of them for 9% each on the S&P 500, and you still finished the year down 19%.
That is true, which would imply, I guess, you'd be certainly not chasing things like the big caps of the NASDAQ. Although, if you look at an Alphabet or Amazon, the earnings forecast for this year are down a lot since the middle of last year for those companies, right? They're down 15, 20, 25%. So you think that there's still more shoes to drop on that front?
Absolutely. I expect every single big cap tech company to report and to have the estimates go down for the March quarter. And in some cases, they could go down substantially. Now, obviously, you can look at this and say, well, Intel had one of the worst guidances ever, and the stock is up still 6% for the month. Microsoft's guidance on Azure was horrific. Sure. It was still up 1% for the month. But I think you don't want to confuse stock prices with fundamentals. And right now, you're starting to see big cap tech starting to take numbers down in a very large way. And the problem is valuations don't really.
And I'm going to stop it right there. We'll go back here a little bit because I want to make a point there. When you're looking at fundamentals of these companies, most of them, and I'm talking big tech here specifically, you see the stocks right there on the screen that they kind of line up there. They have adjusted those fundamentals, and their fundamentals have not deteriorated like other companies' fundamentals have during this downturn. And I don't think anybody is going to think that their fundamentals are going to continue to deteriorate into this year. And as we saw, I haven't gone through NVIDIA's earnings call yet, but all the rest of them up there on the screen are, Amazon, Meta, Google, and Apple. All those have basically adjusted for the year, and it's not terrible. It's not the apocalypse. It's not the worst thing ever. So basically kind of saying, hey, it hasn't adjusted for fundamentals yet. Well, or, the fundamentals relative to the stock price, I would say the stock price absolutely reflects those undervalued points and those undervalued fundamentals within those companies, especially, assuming that they're able to hit the revised guidance that they put out there. Why wouldn't it? I mean, at that stage, they're still trading. Obviously, Apple, I think, not trading historically cheap, but the other ones are still trading in a lot of cases historically cheap still, despite, in Meta's case, it's up, almost 100% since the lows. So, that right there, it's kind of like, I understand what he's saying, but it's not lining up with the narrative. Maybe, this time last year, if you would have said that, absolutely agree. But that's the problem with kind of carrying a bear argument forward. It never seems to last multiple years. And, hey, might have 7 bear market rallies. We may have 8. We may have 9 more to go. Who knows? But 7 could have been the last one too, and we don't see one again. Or, we take another leg down, but we don't make new lows in this one, meaning that, hey, basically the bottom was set. We don't know, but sometimes when you apply the same argument forward again and earnings, guidance adjusts for those companies and the stock price is down and the fundamentals don't erode as bad as they were predicting that they were going to erode last year, and they've already adjusted for it and Wall Street's already beat them up for it, that argument doesn't line up as well anymore. And he's getting into valuations here, and this is where really, really, I'll point at the difference here, and I want you guys to be listening for this next point. When you're listening to anybody on the TV, on YouTube, whatever the case is, because it's very, very important for you to be able to distinguish between somebody talking about something and making an argument, and then the actual reality of how they're making that argument, how it's actually flawed. They're actually looking in the wrong place.
Very large way. And the problem is valuations don't really discount that because you've still got a trailing PE of the S&P of 18 times. Whenever CPI has been above 3% over the last 70 years, that multiple has been 15 times. So you're not getting paid to take the.
So right there's the point. He's talking about, take your stock, Apple, Microsoft, Meta, Google, those right there are the 4 on the screen there. He's talking about those 4 stocks, and then he references valuation for the S&P. There's lots of times where, the S&P can be, overvalued. And it doesn't mean all these underlying stocks are by default overvalued because it's undervalued. And that doesn't mean that because the S&P is overvalued, by default, all these other stocks have to be overvalued too. It's not how it works. The good chunk of S&P that is still overvalued are kind of those old man stocks like we've been talking about, where they're trading at PEs of 30 or more, for like a McDonald's or a Coca-Cola or something like that. And then you have Meta, despite this incredible run, and it's been incredible, right? 100% in a couple months is incredible for any stock, much less a large cap stock like that. And it's still trading at a PE of 15. So to say that, hey, well, the S&P is trading at 18, therefore all these other stocks have to be overvalued is fundamentally flawed. Those disconnects happen all the time as an individual stock investor. Now, if you're going to bet and you're going to buy the S&P overall, I'm not going to disagree with them that, hey, absolutely, the S&P has more to fall. But which stocks in the S&P are going to drag that, PE ratio down while the other stocks will actually be, I won't say fighting on the other end, but causing that swing not to be as dramatic. If Coca-Cola goes back to its traditional PE or McDonald's goes back down to its traditional PE that it normally trades at, that on the flip side, you can absolutely see, Meta's multiple come back up to a more normal valuation as well and still see the S&P fall overall. And you can say that with all the big tech stocks. So he's talking about individual stocks, then he applies, or 4 or 5 of them, and then he applies a metric like the S&P 500, which has 500 other stocks that valuations are weighing against it as well, and somehow making it as, hey, well, these can't go up because the S&P is overvalued overall. And that's just fundamentally false in the first place. Stocks disconnect all the time from the actual indexes themselves. Pull up any chart. Sure, they may seem to move in line with the chart. I know this I think it's this way for you guys, but anyways, I can't draw it without screwing up. Fundamentally, as the indexes go up over time, great stocks tend to move like this. Sure, they both go up, they kind of come down at the same time, but what you notice is they decouple a long time ago, and as they're going up, they continue to decouple over time. Great companies tend to do that and decouple from the indexes. So I don't know, just that's something you want to listen for when somebody makes a case and they're talking about Tesla stock, and then they throw out some, a metric from the S&P or from the NASDAQ. Who freaking cares? I'm talking about Tesla right now. I'm not talking about the S&P. So make sure you kind of keep that in mind as you're looking at this stuff.
Risk. Whereas you can buy a 3-month T-bill, which was one of our top picks coming into the year, and get a return of 4.6%. That's pretty darn good. So I think you need to balance risk versus reward versus just looking at, well, these are down a ton, and so I can buy them. Well, everything's up in January. So it doesn't really matter.
I have no idea what he just said right there. Basically, don't buy Google or Amazon or Tesla or somebody else because you can own 4% on a T-bill. I don't know, especially, if we do get some sort of a pullback here. I don't know, guys. Don't know what to tell you there. I'm not saying it's a terrible strategy. It's just that, for me as an individual stock buyer, when they're undervalued, they're undervalued. And I'm not going to disagree that stocks aren't still a little bit, like for me, Apple's a little bit still overvalued. It just is. But I can absolutely make a case that Google is undervalued. I can absolutely make a case that Amazon is undervalued. You can make a decent case here. I mean, Tesla is kind of reaching, it's kind of hitting the other end of the spectrum here. But I would still say overall, it's still undervalued. And I think would still provide me a better return than 4% over the course of the year. Doesn't mean I could be right. It could be completely wrong. It doesn't matter to me, in terms of short term like that. I'm not into making money this year. I'm into making money 3 to 5 years out. Those gains will come as the stocks actually move out. But if Tesla continues to perform, and the stock price stays beaten down, I don't want that 4% coupon. I want shares of Tesla because I know the run on the other end, whenever things do normalize, is going to be incredible. So, like I said, this is a different type strategy. It's definitely a defensive type strategy. Like I said, he's talking about Intel, and if you work through Intel's earnings, they were awful. He even told you at the front it was awful. It was awful guidance. It was one of the worst ever. And yet he's still saying, hey, Intel is a great buy. So, jeez.
Well, we did mention, and you mentioned last week that you did think Intel was perhaps getting interesting after just being taken apart on that bad earnings guide and everything else. What do you see there? Is it strictly just about, valuation and low expectations?
Well, those are certainly helpful. I mean, Intel's trading at 1.2 times book value, which is pretty low. I mean,
again, somehow Intel being undervalued because it got beat down from an awful earnings is not a good setup as compared to big tech if they are beaten down and undervalued. I don't know. I don't know which one you would rather own, but I would much rather own any of the big tech companies versus Intel. Geez, I don't know, man. Here we go.
Compared to a commodity DRAM manufacturer like Micron at 1.4 times, and you get an idea of how compelling the valuation is. So there you're getting paid to take the risk but you never want to buy something just based on valuation. It's incredibly stupid. So what I'm looking at is the fact that Intel's been...
I got nothing. I don't know. Never want to buy anything based on valuation. I think he follows it up with another point and kind of cleans it up a little bit, but I don't remember. So if that's actually his premise, I got nothing. You don't want to buy based on valuation. Oh, dear God.
Losing share since 2018. And in the back half of 2022, they actually started to gain a little bit of share in desktop and mobile. And the first thing that Pat Gelsinger did when he came in as the new CEO about 2 years ago is go, look, we really screwed up by not moving to EUV, which is, a very efficient way, but incredibly expensive way to...
Yeah, so don't buy based on valuation, but make sure you buy based upon them taking a little bit of market share after getting just absolutely crushed by AMD and NVIDIA and everybody else. And obviously, Apple moving away from them, everything going against them. But yeah, now they've had a little markup there in that. So screw valuation. We're gonna buy based on. I don't know. I can't make this stuff up, guys. This is what's on TV.
Chips, and we're all in now. And so that technology gap that happened with regards to TSMC, that's going to start to narrow. And I think you're going to start to see that pay dividends going forward. The final piece of it is PC demand, and we've been saying this for 12 months. We looked at and said that's just a pandemic beneficiary, just like smartphones, just like e-commerce, just like Zoom. That's going to continue to collapse. That was down 30% year over year for the industry in the fourth quarter. Intel's forecasting their own revenues down 40% in March. I think that's actually the bottom. And don't forget, Intel has a huge presence in China. China's been locked down for 3 years. Once that starts to open up, that should help them a little bit as the cloud vendors in China start to order again and the regulatory pressures come off. So for us, Intel's a lot like our Facebook call, if you remember, after they gave that horrific guidance, after their September quarter, you were sort of getting paid to take the risk. And right now with Intel, if their customers are giving them more share after losing share.
Yeah, I guess the big difference for me, there's Meta or Facebook, whatever the heck you want to call it, prints money. Intel has not been printing money for a very, very, very long time. I mean, we talked about on this channel a lot. I know some of you guys didn't like the fact I talked about Meta. I'm sorry. But all you got to do is look through the financials and go, holy crap, they're burning billions on the metaverse and still printing money. Geez, I mean, stupid amounts of money on the metaverse, and they're still printing money. That's not the situation Intel's in at all. So, I mean, we're not even comparing apples to apples. Great call on the Meta one. I was right there with you on that one, buddy. But in terms of even comparing any financial metric of Intel versus Facebook or Meta, it's just silliness at this stage. It shows you kind of when people are defensive and kind of into bearish plays and stuff like that, kind of where they end up looking for yield and such, and they kind of miss the forest for the trees per se. All right, so there we go right there, guys. You kind of see how when you're kind of looking through this and such, I don't want to argue and say Intel won't make money. But if you're betting on Intel, hey, I'm not willing to buy Google. I think 4%, Treasury is going to do better. But I'm willing to bet on Intel and thinking it has the, thinking you're going to get a Meta-style run, which is what he compared it to, versus that Treasury bill. I don't know. It just seems kind of silly to me. And I don't know where a lot of these guys work through their metrics, and as they're working through their thesis and stuff, it's just sometimes it's kind of mind-boggling for me. Now, I also understand he's a trader. This is what he does. He's a trader. He's not a long-term buy and hold investor. So, of course, his look at it is much more, hey, can I make a little bit of money on this and get out of it and make some cash on the other end? Again, made some good calls last year. I'm not saying Intel is necessarily the worst stock ever. However, when I look at the hallmarks of what made the Meta opportunity so juicy to me, I don't see those same hallmarks with Intel. I don't see growth like Meta had. I don't see them printing cash like Meta had. I don't see an ability for them to pivot into higher margin businesses like Meta can and are doing right now. I don't see their ability to be able to lower CapEx by any considerable measure as opposed to Meta can, just based upon the two different businesses and what they actually do. They're making physical chips, as opposed to Meta, it's all, computer based and such. So it requires a lot less capital expenditure to begin with just to run the business itself. So I don't see a lot of similarities there, and I don't know where the narrative comes from that. Now, again, remember, he's a trader. I'm a long-term buy and hold investor, so we're going to have different opinions anyways. but I know a lot of folks watch CNBC or the news or YouTube or whatever the case is, and you got to be real careful when somebody's talking about an individual stock. I've seen it with Apple in the past. I've seen it with Tesla in the past, to where they're talking about one thing and then they're comparing it to an index, or they're comparing it to unrelated stock over here that hey, we're going to talk about Tesla and we're going to call it a car company, and they're either going to compare it to Ford, or they come over and they say, but compared to Microsoft. And you're just kind of like, wait a second, now we're way off base here. I get it. They're trying to make a point. It probably makes for good TV. I have no idea. But that's kind of those sorts of things. You got to kind of listen through that. And this guy's basically comparing big tech to the S&P and saying they can't go up. They can't make any money because the S&P is still overvalued. And that's just a very broad generalization that I don't think it plays well. I'm very happy that we were buying Meta back, in the 80s and 90s. I'm very glad we were buying Google back in the 80s. I'm very glad we were buying Amazon in the 80s. I'm very glad we were buying Tesla in the, low 100s and 120s and 140, whatever the heck it was. I was very glad we bought on all that sort of stuff, not based upon what the S&P was doing or what the NASDAQ was doing or what anything else was doing, but strictly based on valuation. And valuation is the most critical piece of all this, guys, that I want you guys to take away with you. So hopefully this was helpful, and make sure you check out the link down in the pinned comment. The Valentine's Day sale is live. I'm telling you guys, it's the best value on YouTube, period. Now, I know I'm biased, so I'm sorry I'm biased. But, check it out and at least see what all you get there and see if it's right for you. And click this video here if you want to see the most important stocks in 2023. And click here if you want to see exactly what I'm doing in this market. So thanks for watching, and we'll see you in the next one.